Welcome to the deep dive. Today, we're taking a really close look at the federal bank.
Yeah, we're going to be drilling down into their Q2 FY26 results, which are unaudited for now.
And we'll also be looking at the big strategic moves they're making and, of course, what the market is telling us through the technical charts.
We've got a lot of material for you here. We've pulled from their official investor presentation some key news stories, including a huge investment that made headlines and a detailed technical analysis of the stock.
Right. And our mission here is simple. We want to give you a quick but really solid understanding of the bank's health. Where are they setting records?
And crucially, why did their profit take a dip? You want to get to the bottom of that.
Okay, let's just jump right into the numbers because they tell a really fascinating story of strength, even in what's a pretty tough environment.
It is. The bank calls it steady execution, and you can really see that in the income statement.
But maybe not where you'd first expect to see it.
Exactly. What's really crucial here is the acceleration in their main earning engines. So let's talk net interest income, the NII.
Their core revenue from lending.
Right. It hit a record high. We're talking nearly 2,500 crore. That is a very, very healthy 7% growth just from the last quarter.
That's huge. NII soaring is always good news, means the core business is firing on all cylinders. But what about the other side of revenue, the non-interest stuff?
They absolutely excelled there too. Their fee income, another one for the books, also highest ever at 886 crore.
Wow.
And that's up 13%, not just quarter on quarter, but year on year as well. And this isn't just about raw numbers, it's efficiency. They hit a really important milestone.
Ambitious.
Their fee-to-assets ratio is now sustainably over 1%. That means they're getting better and better at scaling those high-margin services that don't rely on lending.
Okay, so this brings us to the paradox. We have to address this right away because it's what everyone was talking about. If NII and figures are hitting all-time highs, why was the reported net profit softer? I mean, it was up from last quarter, but it was actually down 10% from this time last year. What's the disconnect?
And this is, without a doubt, the most important piece of context for you to grasp. That profit number is all down to one thing: prudence.
Prudence, meaning what?
Meaning they chose to provision, and provision heavily, this quarter, proactively. Total provisions jumped 35% year on year.
So they set aside a lot more money for potential bad loans down the road.
A lot more. They set aside 689 crore, and when you do that, it directly reduces your current net profit. It's a deliberate choice.
So the core engine is actually running faster than ever, but management basically tapped the brakes on the reported profit number to build a bigger safety net.
That's a perfect way to put it. And the proof is in the other numbers. You strip out that provisioning, and the operational strength is undeniable. Their operating profit was still strong at over 1,600 crore, up 5% year on year.
And the efficiency metrics.
Still solid. Return on assets at 1.09% and return on equity at 11.01%. They're running the business well.
That really sets the scene. Okay, so now let's look at where they put that extra caution. Asset quality. This is the bedrock, right? And they're out there claiming decadal best status. Do the numbers back that up?
They do, actually. The improvement is excellent. Their gross NPA, that's the percentage of all their loans that are considered bad right now.
Right.
It dropped significantly to 1.83%. Now, to put that in perspective, it was over 2% a year ago. So yes, it is their best number in a decade.
A drop like that is a huge confidence booster. What about the stuff they really can't recover, the net NPA?
Very, very stable, tightly controlled at a low 0.48%. And importantly, their provision coverage ratio, the PCR, is robust at nearly 73.5%.
Meaning they've already set aside almost 3/4 of the money needed to cover those bad assets.
Exactly. They're very well insulated.
Okay, so let's circle back to that big provisioning number. We know they set aside that 609 crore. Where did they see the trouble that made them be so cautious?
Well, if you look at the movement of NPAs, you see fresh slippage, so new loans going bad, was 579 crore in the quarter.
Okay.
But they clawed back a big chunk of that, about 265 crore, through recoveries and upgrades. The really strategic part, though, is where the provisions were aimed. The source material is clear on this. They focused on the agriculture and the microfinance segments.
Ah, okay, so this wasn't some systemic bank-wide problem. This was a tactical move against specific known risk areas. Why those two?
It makes sense if you think about it. These segments often involve lending that's, seasonal or unsecured. They're just inherently more vulnerable to economic stress. So by provisioning heavily there, the bank is basically getting ahead of any potential problems. It's just smart risk management.
That brings up a really good question about their strategy going forward. We're talking about them being cautious in volatile areas. But at the same time, let's talk about the balance sheet, how they're fueling growth. They're actively shifting their loan book towards higher yielding assets.
They are.
Isn't that a risk? Chasing higher yields in things like commercial vehicle finance when you're simultaneously provisioning against other volatile areas?
That is a very sharp point. And the key is diversification, but also security. They're maintaining that strong, stable funding base while tilting the asset side towards secured, higher-yielding loans that are, still performing very well.
Okay, let's break that down. Funding side first. How are they getting their money?
Well, they've got sustained momentum in deposits. Total deposits are up a healthy 7% year on year. But the real win, the big story for them, is the improvement in their low-cost funding.
The CSA ratio.
The CASA ratio, exactly. It improved to over 31%.
Yeah.
And for anyone listening, a higher CASA ratio means more money from current and savings accounts, which is the cheapest and stickiest source of funding a bank can get. It's a huge boost to their margins.
So a great, cheap funding base. Now back to your point about the assets. Where is the new growth and how is that helping the NII?
Okay, so total customer assets grew about 6.2%.
Right.
But the real story is what they call the asset book transformation. They are deliberately rebalancing.
Away from the lower yield stuff.
Precisely. The fastest growth year on year was in secured, productive assets. Things like commercial vehicle and construction equipment finance. That shot up 28%. Commercial banking was up 25%.
Those are massive growth numbers.
They are. And if you look at that whole bucket of medium-yielding loans, that includes agri, commercial banking, auto, gold loans, loan against property, that segment now makes up almost 44% of their total loans. It was closer to 42% a year ago.
So that intentional shift is what's directly feeding that record high net interest income.
That's it. The strategy is clearly working.
Okay, that really sets the stage for the future. So let's move on. Strategy and innovation. A bank doesn't just manage money anymore. It's a tech company. What are the moves they're making that will drive efficiency for the next few years?
Digitalization. It's the absolute core of everything, and the pace is just intense. I mean, here's a headline figure for you. Transactions serviced digitally across both retail and corporate customers hit 92.57%.
92%? Wow.
And just for the month of September 2025, the digital share was over 93.5%. This isn't just a side project. It's almost total digital dominance.
So it's not a channel anymore, it is the bank. What are the key innovations they've launched that are pushing that number even higher?
They showed off two big ones at the Global FinTech Festival recently. The first is called Banking Connect. Think of it as an interoperable net and mobile banking solution.
What does that mean in practice?
They're aiming for a UPI-like experience for net banking. So, seamless, secure, standardized, high-value transactions. This is a huge deal for their commercial and corporate clients who need that efficiency.
Okay, so streamlining the big money transfers, what was the second big one?
The second was biometric and face authentication for setting or resetting your UPI PIN.
So no more physical card needed.
No card needed. It uses your Aadhaar-linked facial biometrics. This is a game changer for convenience. And it also, it drastically cuts down on transaction failures. It just removes another point of friction.
And this level of execution, this digital leadership, it obviously didn't go unnoticed. Let's talk about the really big news, the Blackstone investment.
Yeah, the market absolutely validated what the bank is doing. The global investment giant Blackstone came in with a huge check, $705 million.
For what stake?
For a 9.9% stake, which instantly made them the largest single shareholder. That kind of conviction from a player like Blackstone, I mean, that's probably the biggest non-financial vote of confidence you can get.
That's a massive stamp of approval. Before we get to the charts, just quickly, what about governance? Are they keeping things tight while they're growing so fast?
Absolutely. The board structure is robust, 73% independent directors. And on the ESG front, they're actually overachieving. Their targets for their green portfolio, for example, were hit so far in advance, they had to revise them upwards.
And the workforce.
A strong gender ratio.
Yeah.
42% women in the workforce. So no, they are definitely not compromising on stewardship while they're chasing growth.
Okay, finally, let's see how the market is piecing all of this together. What story are the technical charts telling us right now?
The charts are definitely confirming the bullish sentiment we've been talking about. The stock has had a really strong run up, almost 20% over the last year. And it's decisively broken out of a long period of just going sideways.
Was there a key signal?
There was. The technical analysts are all pointing to the Golden Cross that happened in early October.
Can you just remind everyone what makes the Golden Cross so significant?
Of course. It's that moment when the short-term trend line, which is usually the 50-day moving average, crosses up and over the long-term trend, the 200-day. It's a classic signal that upward momentum is accelerating and that the long-term outlook is shifting from neutral or bearish to bullish.
And that's where we are now.
That's where we are. The 50-day is sitting comfortably above the 200-day, which confirms that upward trajectory is, for now, intact.
So the trend is positive. What about momentum? Is there a risk the stock is running a little too hot?
That is the one note of caution here. The RSI, the Relative Strength Index, which measures momentum, is pretty high right now. It's at 67.68.
And overbought is 70, right?
70 is the threshold, exactly. So while it shows strong buying pressure, it does suggest we might see a small pullback or just some consolidation in the short term. Technically, the bullish view holds as long as the price stays above that key support zone, which is the 50-day average, around 211 to 212 rupees. Resistance is a bit higher up, in the 236 to 240 range.
This has been a really, really insightful deep dive. Let's try and pull it all together, synthesize that core narrative.
I think what we've seen is a really resilient bank. They're generating record core income from NII and fees.
Which is driven by that smart rebalancing of their loan book toward higher-yielding secured assets.
Right. At the same time, they've hit their best asset quality in a decade, and that dip in net profit, it's not weakness.
It's a sign of prudence. It's
Yeah.
them proactively provisioning against very specific, manageable risks in a few volatile segments.
Exactly. And to top it all off, their aggressive push into digital has earned them massive validation from the market, most obviously that huge $705 million investment from Blackstone.
It's a very compelling picture. Stability, smart planning, and really future-proofing the business. But to leave you with one final provocative thought to chew on, given the bank's relentless drive to get over 93% of its transactions done digitally and their focus on tech like card-free UPI, how does that intense digital migration eventually impact their operational costs and maybe more fundamentally, the need for their physical branch network going forward?
That is the essential strategic question that every single traditional bank has to solve over the next 5 years.
Something to think about until our next deep dive. Thanks for joining us.